Welcome to the next video. In this video, instead of continuation patterns, we're going to be going over reversal patterns. Now, reversal patterns are what exactly they sound like to be. It's a reverse in the markets. Now, in the last video, we looked at continuation patterns that showed us a continue within the current trend. Now, in reverse patterns, it does the exact opposite. So instead of continuing the trend, it sends the trend back in the direction that it just came from. It changes the course of the trend. So if we're in an uptrend and we find a reversal pattern signal, it tells us that we're going to be sent back into a downtrend, and vice versa. If we're in a downtrend and we find a reversal pattern, it's going to send the market back into an uptrend. It's going to change the course of the direction the market's going in. Make sure you guys also take notes on this video, as everything that we're going to go over is highly important, and it's something that you'll need to know on how to find these patterns, because it's going to show you where to find a trade at. The first reversal pattern that we're going to look at is called a double top. A double top is a reversal pattern that is formed after an existing move up. So we see two tops, considering it's called a double top, that form, which the two tops are peaks within the price movement. So here's an example on the screen of a double top. As you can see, there are two tops or two peaks which are formed when price hits a certain level that cannot be broken. This can be considered as a resistance level. So when a double top forms, as you can see on the screen, we have two peaks that get stopped out by a resistance level or a zone. After hitting this level, the price will bounce off it slightly, then return back to the level again, forming the second top. You now have a double top. In the example, you can see the two tops that were formed after the strong move up. Notice how the second top was not able to break the high of the first top. This is a strong sign that a reversal is going to occur, because it's telling us that buying pressure is just about finished and sellers are about to take over. Now, with a double top, we would place our entry order below the neckline, anticipating a reverse in the uptrend. Remember that double tops are a trend reversal formation, so you'll want to look for these after there's a strong uptrend. In a double top, you'll notice that the price drop is approximately the same height as the double top formation. So this is how we can find our key target levels that we want to hit. So all you have to do is measure the height of the double top and then place it below the neckline, and that's how you can find your target levels. Now that we've gone over a double top, let's take a quick look at double bottoms. Double bottoms are essentially the exact opposite of a double top. So instead of the tops forming at a resistance level, you'll now see the bottoms, the lows, forming at a support level. A double bottom is also a trend reversal signal. So instead of going short this time, we're going to go long. Price has failed to break that support level, and once it breaks the neckline of the double bottom, that signals us to go long on the trade. When a double bottom forms, it's a sign that the selling pressure is soon coming to an end, and that price is finally going to break the neckline, going and reversing the trend from a downtrend into an uptrend. Just like a double top, a double bottom, you measure the height of the double bottom, and then that's going to be your key target level that you're going to look for to find your take profit. Now we're going to take a look at the head and shoulders pattern. The head and shoulders pattern is also a reversal pattern that forms within the market. Meaning, when you see a head and shoulders form, it's going to send the market in the other direction. Often, you always see a head and shoulders pattern form in an uptrend. Meaning, you'll have an uptrend within the market, you'll see the head and shoulders pattern, which will then send the market into a downtrend. Now, what exactly is and what classifies a head and shoulders pattern? Let's dive into it. A head and shoulders pattern is a pattern that is formed by one peak, or also known as the first shoulder, followed by a higher peak, the head, and then followed by another peak, which is lower than the previous, which is the other shoulder. So you have a shoulder, you have a head, you have a shoulder. We're going to pop an example of a head and shoulders pattern on the screen right now. As you can see, you have one peak that comes up to a high, then price is pulled back to the neckline, then is sent into a new higher peak than the last peak, which is sent back down to the neckline, and then you have a third movement that is about equal to the first peak, which this last peak is now the last shoulder. So you have your shoulder, you have your head, and you have your other shoulder. And then you have your neckline here. In a head and shoulders, when the price breaks below the neckline, this is when we are sent a signal to confirm the head and shoulders that sends us into a movement to the downside, confirming the sell. A neckline is drawn by connecting all of the lows of the three peaks. Now, the slope of this line, or the neckline, can either be completely straight, it can be sloped up, or it can be sloped down. Typically, when the slope is down, it produces a more reliable head and shoulders pattern. With the head and shoulders pattern, we place an entry order below the neckline. We can calculate our target price by taking the high point of the head from the neckline and then measuring that. So you take the height from the neckline to the high point of the head, and then you pretty much just flip it upside down. So you take it from the neckline to the downside. That height of the neckline to the top of the peak of the head is what price should move from the neckline to the downside. And this is how you can find your target price and your take profit levels.
Head and shoulders is a bearish reversal pattern which forms after a strong move upwards. It consists of a peak as the left shoulder, a higher peak as the head, and a lower peak as the right shoulder, and a neckline which is being drawn connecting the two lows between the shoulders. Let's take a look at the chart. In an uptrend, the first peak forms. After a small retracement, price pushes higher, creating a higher peak. But as the bull trend is getting exhausted, bears drive the price down again. Then, seeing this as an opportunity to buy cheaply, bulls jump back in again, but this time they fail to reach the previous high, and bears take control, driving the price down again. The same as with double top formation, the reversal signal is only valid after the price has broken the neckline, because a lot of time this is just consolidation phase before the uptrend resumes and price takes off, creating new highs. This pattern can produce three different necklines. The first one is a neckline with a rising slope. This one has the largest probability of failing the pattern, because there are no actual reversal signs as the price is still trending upwards, and a lot of times you are more likely to see trend continuation instead of reversal. The second is a horizontal neckline. This is my favorite one because, as we have said in our previous videos, the diagonal support and resistance levels are very subjective, and only horizontal neckline will appear on your chart the same as on any other trader's charts. The third is a downward sloping neckline. This one produces the most reliable reversal signal, as it has already managed to make a lower low. The price target for this formation should be the height from the neckline to the top, measured down from the breakout point.
Now, going off that, there is a inverse head and shoulders, or also known as an inverted head and shoulders. Now, essentially what this is the exact same thing as head and shoulders, but inverted. So instead of coming from an uptrend and being sent into a downtrend, we're coming from a downtrend and we're being sent into an uptrend. It's just the inverse, the opposite of a head and shoulders. It works the exact same, besides your peaks are now below and your neckline is on top. So once again, we have a peak being formed and then it is followed by an even lower peak, which is the head, and then it pulls back to the neckline, and then followed by a third peak, which is the last shoulder in the inverse head and shoulders.
The inverse head and shoulders is a bullish reversal pattern which forms after a strong move downwards. It is the exact opposite to the bearish head and shoulders pattern. It appears after a strong move down and consists of a low as the left shoulder, a lower low as the head, and a higher low as the right shoulder, and a neckline which is being drawn connecting the highs between the two shoulders. This pattern can produce three different necklines. First is a downward sloping neckline. This one is the weakest reversal signal, as a lot of times price will just continue to trade lower instead of reversing. The second is a horizontal neckline, which provides the most objective entry and target price. And the third is an upward sloping neckline. This one has the highest probability of successful reversal, as the price has already made a higher high. Remember, the most important thing about formation patterns is waiting for the break of the neckline, as then and only then the pattern can be considered completed. The price target for this formation should be the height of the formation measured up from the breakout point.
Now let's take a look at a rising wedge. We already covered rising wedge once in the continuation video, but in this time we're going to be looking at a rising wedge and a falling wedge for a reversal pattern. So like we said before, a rising wedge and falling wedge can both be a continuation and a reversal pattern. So what separates the difference and how do you tell the difference? Let's dive into it. Wedge is formed when price consolidates between an upward sloping support and resistance line. The slope of the support line is steeper than the slope of the resistance line, which indicates us that it is a rising wedge. This indicates that higher lows are being formed faster than higher highs, if that makes sense. This leads us to the wedge-like pattern from where it gets its name. With the rising wedge and forming, we know that a big movement, a big splash is coming. So this is a great opportunity to prepare yourself for a good trade opportunity. If a rising wedge forms after an uptrend, it typically tells us that it is a bearish reversal pattern. Take a look at a rising wedge in an uptrend. As you can see, we have an uptrend in this example that is having and creating higher highs and then even higher lows. In this example, a rising wedge is formed at the end of the uptrend. Notice how price action is forming new highs, but at a much slower pace than when price is making higher lows. In this example, we can see we can take the target height of the rising wedge, and that's what's going to give us our target price level. So we measure the height of the wedge, and then we place that to the downside of the wedge when it breaks out, and that gives us our target level. As you can see, it broke out to the downside, and it went even further than our target level. Now let's look at a falling wedge. Just like the rising wedge, a falling wedge can either be a reversal or a continuation pattern. As a reversal signal, it is formed at the bottom of a downtrend typically when it's a falling wedge, which sends us back into an uptrend. When looking at a falling wedge in a downtrend, it typically signals to us that it is going to send us back into an uptrend. So whenever you see a falling wedge pattern form in a downtrend, you can typically expect an uptrend is coming, a reverse in the market is coming. Let's take a look at the example on the screen right now. So we have a downtrend in the market and we see a falling wedge form. We can see that it's creating lower lows and lower highs. It's going to serve as a reversal signals. After a downtrend, the price made lower highs and lower lows. Notice how the following trend line connecting the highs is steeper than the trend line connecting the lows. We can also now take, in this example, the measurement of the falling wedge, and that's going to give us our target price level. Upon breaking to the upside, the top of the wedge, the pair made a nice move upwards that is approximately equal to the height of the formation. In this case, the price rally went a few more pips beyond the target. So if you kept your position open, you could even secure it a little bit more than the actual height of the wedge.
Falling wedge is a bullish formation pattern where price makes lower lows and lower highs, but the resistance line is steeper than the support line. Every new low is created with a loss of momentum and is signaling about underlying strength. There are two basic variations about this pattern. The first one is a bullish reversal pattern, and it looks like this. In a downtrend, the price is making lower lows and lower highs, but as the bear trend is losing steam, the price has lost its momentum and struggles with pushing price significantly lower until the bullishness prevails and price finally breaks to the upside. Rising wedge is a bearish formation pattern where price makes higher highs and higher lows, but the support line is steeper than the resistance line. Every new high is created with a loss of momentum and is signaling about underlying weakness. There are two basic variations about this pattern. The first one is a bearish reversal, and it looks like this. In an uptrend, the price is making higher highs and higher lows, but as the bull trend is losing steam, the price has lost its momentum and struggles with pushing price significantly higher until the bearishness prevails and price finally breaks to the downside.
Now let's take a look at a triple top. A triple top is obviously a reversal pattern. So although a triple top is relatively rare within the markets, when it does occur, it is a strong indication that a reversal is coming. A major reversal is actually coming. So a triple top is essentially a double top just with one more high, one more peak. So it's even stronger than a double top. The appearance of a triple top indicates that at the end of an uptrend is near. So essentially you'll have an uptrend that is stopped out by a resistance that is sent back down to a neckline or a support. That is, price is then sent back up to that resistance, rejected right off of it at the exact same level that the first high was, and then it is sent back down to the support again, which is rejected, then sent back up to the resistance, forming the third high, which is all equal, so it's at a top level zone. And then once price goes and breaks below that lower zone or that support, this is what shows us that the triple top is here and has formed, which is now sending us into a major move to the downside. Here on the screen we have an example of a triple top. As you can see, price is moving up, got stopped out, sent back down, and then came back up, got stopped out at the exact same level again, was sent back down again. Now this is where we could see our double top form, but instead of price breaking the level, we were sent back up once again and got rejected off that zone for a third time. And now we finally broke through and sent to the downside. We finally broke through that level of support for the triple top, forming the triple top. Now let's look at triple bottoms. Just like inverse head and shoulders, a triple bottom is the exact same thing as a triple top. It's just inverted. It's the opposite way. It's the opposite direction. So instead of an uptrend being sent into a downtrend, we're having a downtrend sent into an uptrend. Like we said earlier, this is relatively rare, but when it does happen, it's a strong indication that the reversal will happen. As with the triple bottom, it is generally thought that the longer a particular trend takes to form, the stronger the significant change in price or this change in direction is going to be. So the longer it takes to form, the stronger the move is going to be, the more accurate it's going to be, if that makes sense. One thing with triple tops and triple bottoms, they're typically the longest pattern that it takes to form. You could be waiting weeks to a couple months for a triple top to form. That's why we said they are very rare, but when they do happen, it's very accurate. So it's a great position for you to have a chance to enter on a profitable trade. with trading triple bottoms and triple tops, to find your entry, all you do is take the measurement and the height of it and flip it. Just like we did on all other patterns, you measure the height, and that's what your target level is going to be. To have an entry, what you're going to do is you're going to wait for it to break the neckline, and you can either get on the break of the neckline, or sometimes wait for the retest. If you have a pullback and a retest, when it does break the neckline, this is when it's even stronger confirmation that the trend is being reversed. Lastly, in reversal patterns, we're going to take a quick look at the diamond pattern. Now, the diamond pattern isn't something that we use very common or traders look at, but I personally think it's something that is pretty easy to see, and it's pretty accurate as well. If you can find and locate a diamond pattern within the markets, you have a good chance of finding a profitable trade. So what exactly is a diamond pattern? The diamond pattern is also commonly known as a diamond top. So it's a relatively rare chart pattern formation, but when it does happen, it's pretty strong. So you're likely to get a good trade. When a diamond top forms in an uptrend, price is typically sent back to the downside and vice versa. So when it's formed in a downtrend, it's sent to the upside. As you can see with the example on the screen, it looks just like a diamond pattern. When it's coming from the upside, so a downtrend, price is often sent into an uptrend. When price is coming from an uptrend, it's often sent into a downtrend. Let's take a Now we're going to cover on the whiteboard some reversal patterns. We're going to start off with the double top. So what classifies a double top is we have price moving to the upside in an uptrend, which then gets stopped out, pulls back, so with this, we can see price got stopped out at a resistance, line of resistance, and this will be our line of support, which is holding the price up right here. As we can also see, this right here, this line, is our neckline, what we call a neckline in a double top. So what we mean by a double top is, as we can see, we have price come up, we form one peak, it pulls back, and then it comes back up to that resistance, it forms a second peak. So we have two tops at the same height. Now once we break through the neckline, that tells us that it is a reversal, so it confirms the double top. So like I said earlier in the other patterns, it could have a spike straight down instantly, or we'll have a pullback, and this would be a really good entry right here for a sell. To find your target profit, all we would do is here, say it's 75 pips. We make our target level 75 pips, and that's a double top. Now, let's do the opposite, a double bottom. Now remember, like we said before, a double bottom is the same exact thing as a double top. It's just inverted, it's the reverse. So we have price moving in a downtrend, it's pulled back. Essentially this is where we have our first bottom, second, our line here as the neckline, and then price finally breaks the neckline, pulls back. Remember, it won't always pull back, it might just shoot up, and this is where we have our entry once we have the breakout of the double bottom. Same thing goes with target price level, where you just measure your height distance here, and that's where you find your target level. Now let's take a look at head and shoulders pattern. Head and shoulders pattern is obviously a reversal sign. So we've got our neckline here. And with the head and shoulders, with the head and shoulders, what we do is we have price come marker real quick. So as we can see, you can clearly see we have one peak, which is the first shoulder. Then we have the second, which is the head. And we have the third peak, the second shoulder. Just like our bodies are formed, you have a shoulder, head, shoulder. That's where it essentially comes from. Now with this, same target level, bang, whatever that is, the height, take it there. Remember, to confirm this, it needs to break the neckline. That's your head and shoulders. Now we can do the exact opposite for inverse head and shoulders. Inverse head and shoulders is just the exact opposite. So we have price coming down, bigger peak, sorry, my marker's kind of going dead. So we have the neck. You have your first shoulder, you have a head, and you got your third. Notice your shoulders are equal. On both examples, on an inverted and a normal head and shoulders, your shoulders are relatively equal. Now, it might not always be exact on, but they'll be relatively equal. Once it breaks the neckline, we have our body. So you have to remember, head and shoulders from an uptrend is sent into a downtrend. An inverse is sent from a downtrend back into an uptrend. Oops. Now going off that, likely touch triple tops are relatively rare, and it's going off the same thing as a double top. You just have 3 peaks. Once it breaks, you have your sell. Same thing goes with the opposite, a triple bottom. Price is now coming here, or sent this way. 1, 2, 3. This is a triple bottom. 1, 2, 3. This is a triple top. Like I said, they're relatively rare, but they're strong when they are formed correctly. Let's take a quick look at a rising wedge and falling wedge, the reverse one. So like I said earlier, they're continuation patterns unless they're formed like this. So if you have a price surge like this, and then you see a rising wedge form, so we have price. Since it's not against the trend, remember, if a rising wedge was against this uptrend, it would be a continuation pattern here. But since it's not, it's actually a reversal pattern now. Same thing, you measure it, that's your pip, target level, height. Now, that's a rising wedge. If we do the opposite now, where it is a downtrend with a falling wedge, price is reversed. So remember, if this falling wedge was against this downtrend, we would see continuation. But since it is not, and it is not against the trend, we actually see a reversal. Same thing, you measure height, and that's where you take profit.